Most people start investing believing the hardest part is picking the right asset: stocks, ETFs, real estate, crypto, dividends, growth. The focus immediately goes to what to buy. That assumption is the core problem. The biggest investing mistakes do not come from bad assets. They come from ignoring a small set of fundamental rules that determine outcomes long before asset choice matters. The real financial problem for most viewers is this: they invest regularly, follow popular advice, and still end up with results that are far below expectations. After years of contributions, the balance feels disappointing. Progress seems slow, volatility creates stress. Many conclude that investing doesn't work for them, or that markets are unfair. In reality, the issue is not the market. It is the absence of a clear rule-based framework. Most people think they are doing things correctly because they check the common boxes. They contribute to a retirement account. They buy diversified funds. They hold for the long term, at least in theory. But they mix these good intentions with structural mistakes: inconsistent contributions, poor timing decisions, excessive fees, emotional reactions to short-term movements, and unclear objectives. These mistakes are not obvious individually, but together they quietly undermine results. Consider a simple example. Two investors both contribute $500 per month for 25 years. Investor A follows a loose approach. Contributions are skipped during stressful periods. Allocations change frequently, and decisions are influenced by recent market performance. Investor B follows a simple, consistent rule set: fixed monthly contributions, low-cost diversified investments, and no reaction to short-term noise. Even with the same average market return, the second investor often ends with hundreds of thousands of dollars more. The difference is not intelligence or income. It is adherence to basic rules. The consequences of ignoring these rules compound over time. Missing just 1 year of contributions early in the investing journey can cost far more than missing a year later. Paying an extra 1% in annual fees can reduce long-term portfolio value by 20 to 30% over decades. Reacting emotionally during market declines often locks in losses that markets eventually recover from. None of these outcomes feel dramatic in the moment. They become visible only years later. Another problem is that investing advice is often fragmented. One source emphasizes diversification, another focuses on returns, another highlights discipline. Rarely are these ideas connected into a single system. As a result, people apply rules selectively or inconsistently. They believe they are following sound principles, but in practice, they violate them regularly without realizing it. At this stage, it is important not to jump into tactics or product recommendations. Before discussing portfolios, asset classes, or strategies, the underlying problem must be clear. Investing outcomes are driven less by clever decisions and more by a small number of foundational rules applied consistently over long periods. Until those rules are understood and prioritized, effort alone will not produce reliable results. The purpose of this lesson is not to add complexity, but to strip investing down to what actually determines success. The first step is recognizing that most investing failures are not caused by bad markets, but by ignoring the rules that quietly control long-term outcomes. To understand why most people struggle with investing despite good intentions, it is necessary to look beyond markets and returns and focus on structure and behavior. The problem is not that people lack access to information. It is that their financial environment and decision-making process are not designed for long-term consistency. The first issue is income structure. For most households, investing depends on surplus income, not guaranteed capital. Contributions are made after expenses, and that surplus fluctuates. When income feels tight, investing becomes optional. This creates irregular contribution patterns that weaken compounding. Even small interruptions early on have an outsized impact. For example, skipping $500 monthly contributions for 2 years at age 30 does not just cost $12,000. At a 6% return over 35 years, it costs more than $55,000 in lost future value. The issue is not return, it is timing. The second issue is behavioral. Humans are pattern seeking and reactive. When markets rise, confidence increases and contributions feel safe. When markets fall, uncertainty rises and people hesitate. This leads to buying more when assets are expensive and less when they are cheap. The behavior feels rational in the moment because it aligns with emotional comfort. Over time, it produces systematically weaker results. The market does not punish this behavior immediately, which is why it persists. A common real world scenario illustrates this. An investor starts contributing monthly to an index fund. After a strong bull market, they increase exposure and feel validated. Then a sharp market decline occurs. Contributions slow or stop. Some holdings are sold to wait for clarity. Months later, markets recover, but the investor re enters at higher prices. The long term chart looks reasonable, but the actual account balance lags what consistent investing would have produced. The problem was not the fund, it was the process. The third issue is the absence of a defined system. Many people invest without clear rules for allocation, contribution, and behavior during a market stress. Decisions are made reactively instead of procedurally. Standard advice, such as invest for the long term or stay diversified, is correct but incomplete. Without operational rules, these principles are easy to abandon under pressure. This is why common advice often fails in practice. Telling people to ignore the noise does not help if their system requires frequent decisions. Advising buy and hold is ineffective if contributions are irregular and fees are high. Suggesting diversification does not solve the problem if assets are changed based on recent performance. Advice works only when it is embedded in a structure that removes discretion. Another factor is misaligned expectations. Many people assume investing success comes from selecting the right asset or timing entry points. When results disappoint, they change strategies instead of fixing the underlying process. This adds complexity without improving outcomes. Over time, portfolios become fragmented, costs increase, and discipline weakens. The deeper problem is that investing is treated as a series of choices rather than a system. Choices require judgment, and judgment deteriorates under uncertainty. Systems reduce judgment and increase consistency. Without a system, even good rules are applied inconsistently. Understanding this explains why results often lag, despite reasonable effort. The failure is not due to lack of intelligence or effort, it is due to structure. Until investing is designed as a rule-based process rather than a reaction to markets, standard advice will continue to underperform in real life. When investing outcomes fall short, the cause is usually not market conditions or insufficient income. It is a small set of repeated mistakes that compound negatively over time. These mistakes are common, socially accepted, and rarely discussed in terms of long-term impact. The first mistake is inconsistent contributions. Many investors contribute when it feels comfortable and pause when it does not. This behavior reduces the most powerful factor in investing, time. Consider two people who both plan to invest $500 per month for 30 years. Investor A contributes consistently from the start. Investor B delays for 5 years and then increases contributions to catch up. Assuming a 6% annual return, Investor A ends with roughly $500,000 more than Investor B. Income did not determine the outcome, timing did. The second mistake is reacting to short-term market movements. Selling during downturns or reducing exposure after declines locks in losses. The long-term consequence is not just missing rebounds, it is permanently lowering the base on which future returns compound. A 20% loss requires a 25% gain to recover. Missing just a few strong recovery months can reduce 20-year returns materially. Studies consistently show that investors who attempt to time markets underperform those who remain invested, even when average returns are identical. The third mistake is paying unnecessary fees. A difference of 1% in annual costs does not sound significant, but over 30 years, it can reduce final portfolio value by 20-30%. For example, Investing $700 per month at 6% with 0.3% total fees produces a substantially higher outcome than the same contributions at 1.3% fees. The investor's effort is the same. The decision structure is different. The fourth mistake is changing strategies too often. Many investors move between growth, value, dividends, and thematic strategies based on recent performance. Each change creates friction, transaction costs, tax implications, and time out of the market. Over 10-20 years, this behavior increases complexity and costs without improving returns. In many cases, a simple, stable allocation outperforms more active approaches after costs. The fifth mistake is confusing income with investing success. Higher income allows larger contributions, but it does not fix poor process. A disciplined investor earning $60,000 can outperform a reactive investor earning $150,000 if the former follows consistent rules. Over 20 years, the difference in outcomes can be substantial. The determining factor is not earning power, it is decision quality. The long-term consequences of these mistakes are gradual but decisive. After 5 years, progress feels slower than expected. After 10 years, investors begin questioning their strategy. After 20 years, many realize they worked, saved, and invested without building the level of independence they assumed was inevitable. These outcomes are not the result of bad luck. They are the predictable result of repeated rule violations. Investing rewards consistency and efficiency, not activity or confidence. When rules are ignored, the market does not punish immediately. It compounds quietly against the investor. The critical insight is this: investing failure is rarely dramatic. It is cumulative, and cumulative outcomes are driven by decisions, not income. Once this is understood, the focus can shift from searching for better assets to building a better process. The solution to most investing problems is not finding better assets or more advanced strategies. It is building a simple, rule-based system that removes discretion from the most damaging decisions. This system focuses on consistency, cost control, and time, the variables that reliably determine outcomes. The first rule is automatic: fixed contributions. Investing must be treated as a structural expense, not an optional action. A fixed amount or percentage of income is invested on a set schedule, regardless of market conditions. This removes timing decisions entirely. The mechanism is straightforward. Money enters the market regularly, buying more shares when prices are lower and fewer when prices are higher. Over time, this smooths entry prices without requiring prediction. Stability comes from repetition, not foresight. The second rule is broad diversification with minimal complexity. Instead of selecting individual assets or rotating strategies, capital is spread across a wide range of markets using a small number of diversified instruments. This reduces the impact of any single failure and lowers the need for constant monitoring. The logic is risk distribution. Diversification does not eliminate volatility, but it prevents concentration risk, which is the primary cause of catastrophic losses. The third rule is cost minimization. All ongoing fees, fund expenses, platform charges, advisory costs, and transaction fees must be kept as low as reasonably possible. This is not optimization for its own sake. It is a mechanical advantage. A reduction of 0.51% in annual costs directly increases net returns by the same amount every year without additional risk. Unlike market returns, this benefit is guaranteed. The fourth rule is predefined behavior during market stress. Before volatility occurs, clear rules are established. No selling during declines, no allocation changes based on recent performance, and no suspension of contributions due to market fear. This works because it shifts decision-making from emotional moments to calm planning periods. When rules exist in advance, they are easier to follow. The fifth rule is infrequent review. The system is reviewed periodically, typically once per year, not continuously. Reviews focus on allocation balance, contribution levels, and cost structure, not short-term performance. This reduces unnecessary activity and prevents reactionary changes. Investing improves when decisions are fewer but better. This system is stable because it does not rely on forecasts, trends, or superior judgment. It assumes uncertainty and builds around it. Markets will rise and fall. Returns will vary. None of this breaks the system because its success does not depend on being right in the short term. It depends on being consistent over the long term. Importantly, this approach scales with income and experience. As income grows, contributions grow automatically. As balances increase, cost efficiency becomes even more valuable. The same rules apply at every stage, which reduces complexity and error. This is not a strategy designed to beat the market. It is designed to capture market returns efficiently while avoiding the common behaviors that reduce them. Over decades, this difference is decisive. The system converts effort into outcome with minimal friction. That is why it works, and why it is reliable. All of the rules discussed can be combined into a single, clear investing system. This system does not depend on predictions, complex products, or constant attention. Its purpose is to convert income into long-term assets with the least possible friction and error. The structure has 5 components. First, define a fixed contribution rule. Decide in advance what percentage or amount of income will be invested and treat it as non-negotiable. This removes the most damaging decision: when to invest. Second, choose a simple, diversified allocation that can be maintained for decades without adjustment. Fewer components reduce mistakes and costs. Third, minimize all recurring fees so that market returns reach the account holder rather than intermediaries. Fourth, set behavioral rules for volatility before it occurs. No selling during downturns, no strategy changes based on recent performance. Fifth, limit reviews to scheduled intervals, typically once per year. When this structure is applied, the timeline of change is predictable. After 1 year, the primary improvement is consistency. Contributions are regular, decisions are fewer, and results become easier to track. Market volatility still exists, but its influence on behavior decreases. The investor is no longer reacting to every movement. After 5 years, compounding becomes visible. Assuming $750 invested monthly at a 6% return, the portfolio approaches $52,000. The exact number matters least than the process. Assets are growing, costs are controlled, and behavior is stable. Importantly, progress does not depend on constant decision making. The system does the work. After 10 years, the difference between this approach and an unstructured one becomes clear. Using the same assumptions, invested capital can exceed $120,000. More importantly, the investor has a repeatable process. Market cycles have occurred, yet the system has remained intact. At this stage, investing is no longer stressful or uncertain. It is routine. The immediate actions required are practical. First, calculate how much can be invested consistently without interruption. Second, automate contributions so they occur without manual effort. Third, review all fees and replace high-cost components with simpler, lower-cost alternatives. Fourth, write down clear behavioral rules and commit to following them. Finally, schedule a single annual review and ignore short-term noise. None of these steps require special knowledge or high income. They require clarity and restraint. Investing success is not driven by intelligence or activity. It is driven by structure and consistency applied over time. The conclusion is straightforward. The only investing rules that actually matter are the ones that prevent avoidable mistakes and allow compounding to work uninterrupted. When those rules are followed, outcomes improve steadily, not dramatically, not instantly, but reliably. That reliability is what long-term investing is meant to deliver.